Hi everyone, my name is Joshua Fetchko and this is NoDa Station, a mixed-use development designed to provide a single center for medical office and wellness retail businesses to coexist. A large focus of this development will revolve around providing consumers a health-centric tenant mix and creating a culture of community in the Charlotte neighborhood. Adaptive reuse of an underperforming two-story, 200,000 brick retail warehouse located at 2920 North Tryon Street will increase profitability of the space and add a solution for the lack of healthcare offerings in the marketplace. A symbiotic tenant mix like urgent care, ambulatory care, and routine care medical offices will partner with an organic market, fitness studios, and a community rec center to become e-commerce proof and allow the consumer to visit multiple businesses in one stop. The target acquisition price of $8.5 million is below market rates for comparable assets due to the lack of income and underperformance of the current property. We are pleased to offer this property at a 10% unlevered IRR and an 18.33% levered return rate. The real estate market in Charlotte has been lucrative due to population and job growth from favorable business tax incentives for large company headquarter relocations. In terms of medical office rent, the average rent per square foot is $32 triple net, and Class B retail is currently trading at $26 a square foot triple net. Rental growth has been positive in both sectors, with medical office space growing 5.4% annually and retail space growing 4% annually year over year. In terms of vacancy in the market, it's driven heavily by new construction offerings. The time to lease is a bit quicker for medical office space when compared to retail at about 8 to 10 months respectively. In terms of investment sales in the market, it is a seller's market with compressed vacancy rates and steadily performing average rental rates. However, there is a buyer's opportunity in repositioning underperforming assets, which is something we look to take advantage of here with this proposal. Currently, market rates are trading at $190 a square foot for medical office space and $150 a square foot for retail space. In terms of demographics within 5 miles of the site, the total population is roughly 300,000 individuals with an average age of 35.5 years old. Additionally, within a 10-mile radius from the site, the average household income is an estimated $90,000 annually. And within a 3-mile boundary from the site, 34% of the population has an annual personal income of greater than $75,000. In terms of job growth, Charlotte has been a historical financial hub on the east. The market has recently received the relocation and expansion of companies such as Honeywell Technologies, Lowe's Hardware, Truist Bank, and Duke Energy, which has bolstered the average household income by 10% over the last 3 years, according to census data. The site was selected for close proximity to uptown Charlotte and with the price point of a suburban asset. In terms of transit and accessibility to the site, our consumers will be able to walk from the Lynx Blue Line 36th Street station to our site. This is a Charlotte's passenger railway system that spans 19 miles and carries around 25,000 average daily riders. The main egress for roadway frontage is off of North Tryon Street. The site does incorporate 270 feet of frontage, which counts about 23,500 daily trips, according to North Carolina Department of Transportation. In terms of site conditions, there are no stormwater management or contamination issues. The easements from our legal review are non-exclusive and are for maintenance access only. The largest site condition is the possible disruptance from a bordering railway. However, we feel that this could be featured as a sign of progress and embraced by our tenants as a development theme. There is a need for rezoning of the site, which is currently I2 industrial use. However, the development team feels this is low risk and will engage real estate attorneys early due to the fact that the property is engulfed by other mixed use businesses as well as sits in an opportunity zone. In terms of the trade market area, we did set the boundary at a 10-minute drive time. However, we do realize a high volume of commuters to Charlotte can become consumers to the site. If you look at the map to your on the screen, there is a couple of things to note. So all of the blue flags are multifamily developments, which we see as large consumer basis for this site, and the remaining tags are all medical, fitness, and grocery-related businesses in the NoDa neighborhood. There is only one grocery store, which we see as a large opportunity to anchor our development with an organic market. In terms of best use, the market demands point toward a need for both medical offerings and premium retail. In an effort to remain experiential, NoDa Station will look for health-focused retail tenants and community-focused offerings. The symbiotic relationship will strengthen our investment. And for example, we see our physical therapy patients being able to stop by the market on their way out of their therapy session. As part of a leasing strategy for the development plan, we plan to engage a brokerage house with both strong medical and retail presences. Our medical office and large retailers first to enter the site will be a priority. This will increase rent and strengthen our cash flows as it goes into our financial analysis. And we will look to retain a tenant that currently does occupy. There's an education training center for healthcare professionals that we plan to incorporate onto the second floor of our development. The development overall laid out will incorporate central community common space as well as a raw under construction in progress look. And we do plan to engage our partners with a target value design initiative that is based around some of our lean culture practices as a business. In terms of our budget for development, we do have a cost totaling $28.3 million, which is inclusive of the $8.5 million in acquisition costs, due diligence costs, and all of the hard and soft costs for design and construction. We do see our construction scope currently totaling about $145 a square foot. That incorporates exterior glazing upgrades, installation of a new TPO roof, upgraded MEP and building control systems, along with high dollar finishes and ADA compliant upgrades. We will be offering our tenants a $20 square foot TI allowance to build out their space as well. In terms of timeline, we do see 3 years of stabilization, funding of acquisition in year 1, pre-leasing and construction in year 2, and then a complete 100% occupancy in year 3. In terms of our financial analysis, our leveraged IRR, as stated, was 18.33% on the property. This does account for a 12% vacancy loss and reimbursable expenses through triple net lease structures. The target rental rates are slightly below market in order to reduce risk during stabilization. However, they are adjusted off premium market rates due to the niche symbiotic offering for businesses within the development. The debt service cover ratio is just over 1 starting in the second year, and a stabilized asset, it climbs to 1.6 starting in year 7. Our debt was sourced through primary and mezzanine loans. The primary loan is structured at 6% interest on 68% LTV, and the additional $3 million mezzanine loan was acquired to assist during our stabilization period and structured at an 8% interest rate. The total annual debt service is just over $2 million, and the remaining $5.3 million we will look to needed to fund the development. We'll look to source from equity partners. As the GP on the development, J-Mark will contribute $530,000 of an equity investment, totaling 10% of the required equity. The remaining equity will be offered to the current owner as a buyback after acquisition, and then sold as equitable shares of $250,000. The LP preferred return rates are currently calculated at a 4.68 equity multiple. There are a few risks according to the property. The rezoning, which was mentioned before, will drive a risk if we cannot get that adjustment to mixed use zoning. There are possibilities for additional site or environmental conditions that were unseen in feasibility, and we'll plan to do a phase 1 environmental and geotechnical report to uncover any of those conditions. There is a possibility for a shift in market demand, which we take pride in our market research, and will continue to do so throughout our hold period and development of the property to make sure we can account for any of those adjustments with our brokerage team during leasing. In terms of our sensitivity analysis, rents, both blended medical retail rents, we see these as securing the medical office space to help our cash flow strengthen and decrease our exposure to the retail volatility in rent. There is an opportunity for construction costs to climb $10 a square foot higher than its current target and still maintain the 10% unlevered threshold. And we do have the ability to go to a GMP of $9 million on the acquisition price and still preserve our investment threshold of an unlevered IRR 10%. Any vacancy upticks in the property above the 12% will have significant impacts on the returns, and the development team plans to stay engaged with tenants and brokerage actively to manage these lease commitments. In conclusion, this is a rendering of the proposed NoDa station redevelopment designed to be a solution for consumers' health needs in an accessible, community-focused development. J-Mart seeks equitable contributions to establish a place where healthcare is an experience and interactive, as this ensures limited competition from online e-commerce solutions. Thank you for your time.